Okay. Okay, welcome back everyone. Welcome back from your lunch. Hope that everything has been good. Okay, some of you are saying there's some headache valuation. Okay. Okay. We heard CSCO, there was some headache. Wei Yang, what was the stock that you were looking at?
Disney.
Disney.
Yeah, Disney.
Okay.
Okay, maybe we can take a look at because I think Nita was one of the first to post her question on KO. Maybe we can take a look at KO first.
KO first,
yeah.
KO, you got KO'd by KO. Hold on, let me just zoom in a little bit more. Okay, let's look at KO. KO Morningstar. Oops, I realized that I didn't share screen. Let me share screen. Okay, we have 102 participants now.
Okay, that's great.
Just share screen. Where is it here? KO. Where did my KO go? Never mind. Okay. Are we going to do a full one or just a valuation?
I think we can just do a quick full one.
Full one,
Yeah. Okay, I created a KO tab for you already.
KO,
Yeah.
Okay, we just do a very quick right? Okay, so for KO, can you just tell me, okay, as I go through each criteria, can you just tell me how many points you will put for each criteria?
Okay, Nita said her fright was 7, so maybe we can just quickly go through it.
Okay.
Yeah, okay.
So free cash flow, Nita, okay, so you all will put 1, okay? So for free cash flow, I'll put 1, okay? ROE, I will put 55. Okay. ROE, I'll put 2. Okay. Interest coverage. How about interest coverage? 13.94. Not too bad also. Okay. 13.94. So it's another 2. Okay. EPS. For EPS, what would you give? For EPS. Okay. 1. A lot of ones. Okay. So I'll just put a 1 for EPS. And for the last one, DE ratio. Okay, DE ratio. I'll go to financial health. The last one, 1.71. I'll put a 0. Okay, DE ratio, very clear cut 0. Dividends is 1. Okay, so, okay, yes, we also got a 7.
Okay, Ming Chun has a question which is quite interesting. So as you all can see, right, this is really the power of community, because all of us will be looking at different stocks, which actually allows us to actually see some inconsistencies or some exceptions, okay, to certain rules. Then we can discuss further about it. Like for example, Ming Chun talked about the payout ratio for KO.
Yes.
Yeah.
Yes. In fact, okay, what is the payout ratio? Okay, let's see. Let's just see. For Coca-Cola, okay, this is the payout ratio. Okay, what payout ratio means is based on the earnings per share. Okay, they are giving out 88 cents. Okay, look at this. 2010, their earnings, they earn $2.53 per share, but they gave out 88 cents in terms of dividend. So the payout ratio was correct. Okay, dividend divided by EPS, 38%. So this year, look, okay, 2018, Their earnings per share was 150, but they're giving out $1.56. That means on top of everything they earn, they give out more. So can you tell me, is this sustainable or not sustainable? Okay, sustainable or not sustainable? Not, not, definitely not. Okay, so we want to be very conservative. Okay, for us, our benchmark is as long as the company is paying out more than 90%, okay, in terms of payout ratio, it will not be sustainable. No matter how high the dividend yield is, actually we won't look at it. Okay, for if it's consistently paying out 90% or more, okay, they cannot sustain that dividend payout. Okay, so right now, is Coca-Cola doing okay? Is it sustainable? Why would they pay out more than 100%? Okay, this is very, very subjective. Maybe that year they really need to pacify the shareholders. Okay. Okay, Samuel, wow, you are very sharp. It's 1.04, but why is the payout 211? Actually, right now, I also don't know. Okay, right now, I also don't know. Okay, maybe they borrow money to pay dividends. Maybe they dip into their savings. Okay, all right. So you just take a look, just do a very quick check, okay, between the dividends and earnings per share. It needs to be more. Okay, the earnings per share need to be more than the dividends. All right. Okay, they may be borrowing money to pay. Okay, they may be dipping into their savings. We don't know yet. Without going to the financial statements, it is very hard to say. If over 90% means won't invest in the shares, yes, that means no matter how good it is, I will wait and hold. Okay, I will just wait and see. All right. Tax rebate. This one I don't know. I need to check. I haven't checked for Coca-Cola. All right. So this is one thing you look out for. Okay. So in terms of valuation, okay, let me go to Coca-Cola. I'll click on valuation. Okay. Price to earnings. Okay. Right now it's 19.66. 5-year average was 45.04. Okay, at a first glance, is this over or under value? Over or under? Just at a very quick glance, okay, it is under, it is quite undervalued. All right, so let me just fill in the valuation. 19.66. Okay, even Google came out with 19.66. Let me check again. Coca. Yes, it's correct. The 5-year is 45.04. 45.04. All right. I think you're doing it, Okay, Sarah is now calculating, okay, the price.
Oh, why don't get them to practice lah?
Okay.
Because they need to practice the undervalued, what is the PE? You need to look at the price history.
Okay, so what is the undervalued PE? What is an acceptable undervalued PE? Okay, can you just let me know? Then I'll type it in. Is it 19.66? Let's see. Okay, there is 12.86. All right.
I think 19 is quite a fair value.
Yeah, okay, 19 is quite fair right now. Okay. So I will just put 19.
Okay, so actually currently it's already undervalued.
Okay. All right. How about the 5-year PE? Okay, we already said it was 45.05. Okay. How about overvalue? How high can Coca-Cola's PE ratio go? How high did it ever go to? Okay. In fact, okay, it went to 64.86. Okay, 64.86. Oh, okay, not supposed to type here. Okay, can. Okay, so can we just do a quick calculation based on current earnings? Okay, what is a share price? Okay, there are a few ways to go. Okay, you can actually, okay, right now, the current earnings is 2.32.
Can we check based on Morningstar? What did they write?
Morningstar. Yeah. Same.
Yeah, 2.32.
2.32.
Okay. Yeah.
Okay. In Google, it's 0.73. Let's see. Let's see. Okay, no late. Don't see. How do you get Hadi? How do you get 0.73? Let me check again. Let's check. Okay, I think what you saw was the quarterly one. Okay, we are not looking at the quarterly one. We are looking at the yearly one. Okay, yeah, no problem, no problem. This is good. Okay, all right. So for the yearly one, 2.32 is okay. So how do we calculate this? Can anybody tell me? What's the undervalued share price? 44.08. What's the? Okay, it seems like. Yeah, correct. Okay, 44.08.
Okay. Yeah, Gordon has written the formula there. Okay.
Okay. How about a fair value? Yeah, it's around 104. Okay, 104.5.
You're typing into that.
Oops. Okay, 104.5. All right. And how about for overvalue? Okay. How about overvalue? 64.86 times 2.32. Okay, 150.5. Okay. So right now, based on P ratio only, okay, is it a good time to enter Coca-Cola? Good or no good? Yes, yes, okay. So was it Nita who asked about Coca-Cola?
Yep, it was Nita.
Nita. So Nita, what was your headache?
Okay, maybe I can understand where she's coming from. Okay,
Mm.
so maybe I can show.
Okay.
Yeah. Okay, so right, I think Nita's point right is that this is actually quite large 104, because we take a look at KO's price history. Okay, so let's say we take a look at the all right. Okay, you can actually see that it's a little bit unrealistic, because based on what we calculated, the fair price is $104 and overvalue is $150. Okay, but you can see that based on the all chart, right? Actually Coca-Cola never even hit 104 before, and 150, needless to say Okay, so yeah, so it's quite funny So I can understand. So Nita, was this your problem? If it's your problem, can you type yes? Okay, so if this is the case, right, then we actually need to, okay, thanks Nita. Okay, so it's very good that we bring up this kind of example so that we can actually be very realistic in how we calculate. Okay, so if this is the case, then there are two, is either one of these two problems. One is our PE fair price, this one, right, was actually not done correctly. The second thing is the EPS that we got, right, it could have been a one-off like that. Okay, so okay, let's take a look at EPS first. Let's take a look at EPS first. Okay, so looking at Coca-Cola, right, would you all say that 2.32 is an EPS that you want to use? Yes or no? If you can type yes or no. Is this a EPS that you want to use? Yes or no? Okay, so you can see that, okay, based on the values, right, the 2.32 EPS, some of you say is quite high. Okay, so if let's say you want to compare it to previous years, let's say, Okay, can you just type in maybe what would be, okay, so then if you don't want to use 2.32 because it looks like a one-off thing, could there be an EPS that you're more comfortable using? Which one will you use? 2.07, 1.5, which would it be? Can you just type it in? Okay, 1.8. Okay, some of you use 1.5. Okay, all right. So just take note, right? The lower the EPS that you use, okay, the more conservative you are, lah. Okay, so maybe we can take 1.5 to 1.6 because it has been quite consistently at 1.5 to 1.6. Okay, so some people use average. Okay, so I think if you average this out, okay, let's take a look. We average it out 1.6. Let's take the 5-year average, lah. 1.67 plus 1.49 plus 0.29 plus 1.5 plus 2.07. Okay, we divide by 5. Okay, it's around 1.4, 1.5 lah. Okay, so is everybody okay if we use 1.5 as the earnings per share? If that's okay, can you all type yes? Okay, let's use 1.5. Okay, so over here, okay, we brought it up that, okay, the EPS of 2.32 is a little bit unrealistic. So let's put a note here, use 1.5 as a 5-year average, okay, for PE valuation calculations. Okay, so for people who actually have problem with EA and then like AT&T, right? Okay, it could be a case where you are using a very one-off kind of EPS. That's why the stock price is not very realistic. Okay, so now let's take a look at 1.5. Okay, second thing we need to evaluate is this PE ratio that we cited, right? Is it actually a fair one or not? Okay, so for example, now the fair price is a 5-year PE, which is 45.04. So let's take a look at this. Okay, now the 5-year average was 45.04. Okay, why? So let's take a look. Okay, so for 2019, it was 29 lah. 2018, there was a very big spike to 64. Okay, 2017, 44, 2016, 25, 2015, 27. So why is it that it has to come to 45, right? Okay, why do you think it has actually jumped to 45 for the 5-year average? Can you tell me? Why do you think this PE ratio is so high, 45? Why? Because of 2018, right? Okay, so then if you take a look at, very simply, just take a look at the 5-year average. Just take a look at this. What would be a comfortable PE ratio you think would be fair to enter? Because right now we want to discount this 64, right? Because it looks like a one-off kind of thing. Okay. Okay, it looks like quite a one-off kind of thing. So okay, so you are saying between 27 to 30 lah. 27 to 30. Okay, I think that is quite fair. Okay, let's take a look at further, right? When we look at the earlier years, okay, you can see that it has been the 10s and sometimes in the 20s. So for this purpose, right, we may want to discount the 64 and the 44 because it looks like one-time off kind of effort. Okay, so okay, some people are saying take average. Okay, so since this was Nita's research, right? Okay, maybe we can try to take the average. Okay, so let's see. Okay, let's take a look. Okay, so over here we have 13, 12, 18, 21, 23, 27, 25, 29. Okay, and currently is 19.66. Okay, so let's just add up all the values and see lah. Okay, so we take this 29.44. We take the ones that are more representative lah. Okay, 29.44. Okay, then we add. Okay, this one do you want to consider 64? Yes or no? No, don't want. How about 44? Can you tell me 44? Do you all want to take or not? Also don't want. Okay, so let's take this one 25.13. Okay, plus 27.36. Okay, 27.36. Okay, all right, 23.46. Okay, let's continue on. Okay, then 21.40. Okay, then okay, I'll just ask your view lah, because let's do this together. 2012, it was 18. Do you think is fair to put this in as one of the data points? Yes or no? If you want to put in, you put yes. If you don't think it's a good enough data point, you put no, because this was actually from quite some time ago. Okay, I see more no's than yes. Okay, so that means you all only want to consider the 20s lah. Okay, the 20s. Okay, so I've already added up everything together. So this consists of 1, 2, 3, 4. Okay, 5 data points. Okay, so what I got was 126.79. I divide by 5. Okay, actually I get around 25.36. 25.36. Okay, so over here, I have actually adjusted. Okay, I have adjusted. Okay, I adjusted it to 25.36. Okay, so this is very good because we actually see that, okay, many times, right, it is not very straightforward, okay, but we need to know how to be nimble as investors. Okay, so can you all type in nimble? Type in nimble. Okay, type in nimble. Okay, so what we really want to teach you is how to fish and how to be nimble when certain things do not follow according to our rules, okay? Okay, so next thing, let's take a look at when it will be undervalued. Is 19 fair or not? Okay, so let's take a look. Okay, is 19 fair or not? Okay, so let's take a look at previous PE ratios. Okay, so 2010, it was like 13, 2011, 12.86, 2012 was 18.40. Okay, then we have the 20s range. And then within the 20s range, suddenly currently 19.66. Okay, so what do you all think is undervalued that is achievable? Do you think it's 19.66 or do you all think it's like 18.40 or 12.86 or 13? What do you all think? Can you all type it in? At which PE ratio do you all think is undervalued? Okay, all right, okay. So I think some of you are discounting the 2010, 2011 because it is a bit far off and it only happened in the first 2 years. Okay, so what we can do is we can take the 18.401, okay, together with this 19.66. So we can maybe target 19 lah. We can target maybe 19. Okay, so over here we can target 19. Okay, so so these are no change. Okay, but all these numbers we have to change because the EPS we have actually already recalculated. Okay, so now let's take a look at what will be overvalued PE. Okay, so over here, clearly 64.86 is clearly overvalued lah. Okay, I think we can also consider 44.12 as overvalued. Okay, yeah, okay, so let's take the range 44.12 to 64.86. 44.12. Let's take a look. Okay, all right, so with this, right, let's calculate the share price right now. Okay, using 1.5 as the EPS calculations. Okay, so undervalued will be 19 times 1.5. Let's see what we get. Is it correct? Correct. Okay, we get 19 times 1.5. What do y'all get? Okay, 28.5. Okay, this is really, if Coca-Cola reached 28.5, I think everybody will actually go for it lah. Okay, let's look at the fair price, the adjusted one. 25.36 times 1.5. Okay, 38.04. Okay, and then let's look at the range, 44.12 times 1.5. Okay, so we actually have the lower range, 66.182. Okay, current, so let's use 1.5 again. 1.5 times 64.86, which is the really overvalued price. What do y'all get? 64, okay, 97.29. Okay, so right now I hope that you all actually benefited from this exercise. What we have done is we have been nimble. Number one, we took a look at the EPS to see what is actually a more accurate EPS to use for our calculations. And number two, we actually took a look at the PE ratios. Okay, we discounted the outliers in order to calculate the fair price. Okay, and then after that, from there, using the adjusted EPS, we actually calculated the entry range. Okay, so right now our entry range is around $38 lah. Let's take a look lah. Okay, so okay, $45 and then at fair value is $38. So let's take a look. So we just draw a line here. $38. Okay, Nita, can you tell us, does it make more sense to you now? If it makes more sense to you now, can you type yes? Yep, so it makes more sense to you now, right? Okay, so fair value is $38. So what we can do is we can wait for Coca-Cola to go down to $38. And what would be our target overvalued price would be $66, which actually in this case, it is also more realistic, $66 around here lah. Okay, around here lah. Okay, so this will be when it's overvalued. Okay, $66. Okay, overvalued. Right. Okay. So, Nita, I hope that this, okay, but I'm not comfortable. Fair value is not a range. Okay, if you're not comfortable that fair value is not a range, then you can actually consider your undervalued one. So actually your range is 28.5 to 38.04. Okay, and also currently, if let's say you want to enter now, okay, let's say you want to enter now, right, Nita? It's also possible because actually based on the price to earnings is 19.66. Although you have to be aware that this is based on the EPS of 2.32 lah. Okay, you have to bear in mind it's a case of it's based on the calculations of 2.32. So you have to go back to yourself and ask yourself, are you comfortable with taking this value to get the current share price, right? Okay, that's great. Okay, thank you, Nita, for raising this so that we can actually all learn together. Okay, so right now, we actually saw that many of you have uploaded your homework. Do we have time to go through one more homework?
No.
No more time. Okay, so we have no more time to go through one more homework. Okay, but do continue to post your homework there and we will definitely get back to you, all right? Okay, we are actually going to go into, we're actually going to do some adjustments to the schedule. Okay, so we have already covered fundamental analysis. This one is actually fried. Okay, and then we actually did some valuation as well. Okay, we did PE valuation. Okay, and then technical analysis, we actually just drew lines only, lines and waves. All right, very basic ones. Okay, so what we're going to do is we are actually going to bring this over, the deepening the understanding, we are actually going to bring it over here right now. Okay, then the income generation and all that, we will actually move it over to day 2 so that actually we can do this when you all have a better understanding of the companies. Okay, for Fibonacci, we use that as a support to your PE valuation or your fundamental valuation. Okay, so Christopher, that one, okay, as what was mentioned, right? TA, we always use that as a confirmation for FA. All right. Okay, so, okay, Joe, are you ready? We can actually go on to the, okay, wait, let me see. Okay, all right, so if you're ready for FA part 2, can you all type FA? FA. Okay, so right now, Joe is going to take us through two parts, okay? So number 1, okay, your company analysis, so far, you all have based it just on fried, okay, which was the basic level. Now we are going to actually he's going to cover the other components of the fried snake so that you actually take a look at even more components to determine your portfolio allocation and your final score. After that, we'll go for a break and then we will cover the other valuation methods so that you can strengthen your entry price. All right? Okay. Thanks,
okay,
Joe.
come. Okay, don't worry about so much about the valuation first. Later when we cover the other valuation models, okay, hopefully everything will make sense. And I think it will make a lot more sense to you. Right now, it's a little bit fluid. It's fine. It is totally fine. Okay. So how many of you were attended Suresh's Facebook live sharing, the one on the how to read financial statements? If you attended, okay. Okay, great. So many people attended. Wow. Okay. Okay, so this part on the risk and the economic mode, you need a lot of information from what Suresh taught you. Okay, the 10K report, okay, and the section 1A and section 1B. Okay, so for those who did not, for those who are totally new, don't worry, we are here for you. Okay, let me just bring you there. All right. Okay. Where is the slide? Oh, yes. Oh, yes. Thank you, Adam. I almost forgot. How to spot a potential cheat. Okay. Okay. This is the one that I will show you. Okay, you may want to take a screenshot. These are the 4 things that I check out. Okay, you may want to take a screenshot. You may want to write it down. Okay, you may want to write it down. Okay, I'll go through one by one what it means. All right, I'll go through one by one what it means. Okay, if you are ready, just let me know that you are ready. Just let me know ready. Okay, great, great, great. You are ready, Okay, so the first thing is, okay, I know in Friday I asked you to look at the EPS trend. Okay, if it's increasing, positive, consistent, and increasing, we will give 2 points. But, okay, can you go to McDonald's Morningstar? Okay, can everyone go to McDonald's Morningstar and you tell me how many points would you give for McDonald's EPS only? EPS only. I'm only interested in EPS. Okay, go to McDonald's Morningstar. Okay, 2. Okay, Yanqing says 2. Okay, a lot of you say 2. Okay, great, great, great. Okay, in fact, yeah, if I look from here, yeah, only 2014, 2015, it dropped slightly. After that, it went back up. Okay, but I want you to look at another indicator. Okay, I want you to look at the number of shares. I want you to look at this number of shares. Yes, Pauline, you're right. The number of shares have been dropping quite drastically. Okay, in fact, it has reduced by almost 30%. Yes, Christopher, this is a share buyback or this is a share repurchase. Remember earlier on, okay, what is the formula for EPS? Where is it? Where is it? What is the formula for EPS over here? It is net income divided by the number of shares. If the number of shares decrease, naturally, your EPS will go up or down. Okay? EPS will definitely go up. Okay? I don't have to be making a lot of income. Okay? I don't have to make a lot of income compared to the rest of the years. My EPS will also show that it increases. Okay? This is one way that companies manipulate the EPS. Okay? So you just look at McDonald's, EPS is solid. Why? Because they have been aggressively, very aggressive. In 10 years, go down by 30%. Okay? They have been aggressively trying to buy back their own shares, and that's why EPS goes up. Okay? So this is the first point. Okay? Is share buyback a good or bad thing? It depends. Okay? Let me explain why. Okay? If the company has a lot of money, has so much money that he doesn't know what to do with it. Okay, for example, Warren Buffett. He doesn't know what to do with his money. And to him, the best company to invest in is Berkshire Hathaway. So what does he do? He buys back the shares when he thinks that the valuation is good. Okay, because to shareholders, this will really up the EPS a lot. But if the company that you are looking at has very high debt, not a lot of free cash flow, is it a wise or unwise thing? Okay. All right. Is it a wise or unwise thing to keep buying back the share? Okay. Unwise, especially for companies that has very high debt. You should be using the money to repay the debt. You will be saving a lot on interest. Okay. Why are you buying back your own shares? All right. So this is something that you need to look out for. Okay. You should be reducing your liability. Yes, Veronica, you are totally right. Okay. And look at McDonald's book value per share. Currently, it is negative. It means that they have a lot more liabilities. So this is the main reason why I refuse to buy McDonald's shares or hold McDonald's long term. Okay. While in the next 2 years, 5 years, maybe I don't see, maybe McDonald's will still be around. Okay. I hope McDonald's is still around so that I can eat McSpicy. All right. But I will not, I'm very, very unwilling to put my money in McDonald's simply because of this reason. Okay, I don't know when is the day where the debt, the share repurchase will balloon and burst up in their face. Maybe it will not, but I just want to stay clear. All right. So this is one way. The second way, okay, to spot a cheat, manipulation, okay. So in case instead of looking only at EPS, right, you may also want to check the net income to see if the income is increasing. Because if the EPS is increasing because of increasing income, is it good or bad? Okay, if EPS increases because of increasing income, it is good. Okay, it is fantastic. All right. Okay, the other one is, okay, if you see a very, very high ROE, don't be too happy. Okay. Okay, Angela, when ROE book value is negative, it means, okay, look, Angela, our book value or equity means, okay, all assets minus all liabilities. Negative means they have more liabilities than assets. Okay? Can? So when you see a super high ROE, the first thing I will check is, I'm not too happy. I want to see whether they manipulated this high ROE. How? It's actually very simple. Remember this formula? This formula over here. Okay? Your ROE is actually your income divided by equity or book value. Okay, if I want to boost up my ROE, what can I do? If my net income cannot increase, I must decrease my... Yes, Bernie, you're totally right. I must decrease my equity. And how can I decrease my equity? Okay, I borrow more money. Because why? Okay, equity is equal to assets minus liabilities. Okay, yes, increase liability. Correct. Okay, Christopher, ROE for McDonald's is dash because the book value is negative. Okay. Junjie, is it dilution? I'm not too sure whether I can call it dilution, but it's definitely manipulation. All right. If my company, I want to boost the ROE, all I have to do is to quickly borrow a lot of money, and suddenly my ROE will increase. All right. Not because my net income increases, but because my equity decreases, and that is super bad. Okay. So when you want to check whether this company, okay, is doing something funny, okay, when the book value is so high, go and check the book. When the ROE is super high, or especially all of a sudden, okay, maybe the previous year is like 2%, suddenly it became 40%. Go and check the book value. Okay, after checking the book value, you can also check the DE ratio. If book value is very low and DE ratio is super high, you know that this company is up to some funny business. Okay, they are trying to cover up some things in their financial statement. Okay, that will be a very strong red light to me. So far, okay? If it's okay, can you please type okay? Or make sense? Yeah, Xianqing better eat more McDonald's. Yeah, makes sense, definitely. Yes, Christopher, you're okay? They can manipulate the rest, which is the last one. Okay, I'll be coming to it. Okay, payout ratio, Ming Chun has already asked this question just now. So if you see a very high dividend yield, okay, check the payout ratio. Is it sustainable? Are they paying through their noses just to maintain the illusion that they are paying a good dividend? Okay, so must check the payout ratio. And the last one is already quality of earnings. Okay, does most of their net income go to their free cash flow? A few years, sometimes they want to expand, they want to build new capabilities, they want to build more facilities, they want to acquire businesses. It is very natural for the free cash flow to decrease, okay, even when the income is good. That is fine. That is totally fine. But if you look at the trend and you realize that, hey, a lot of the net income is quite high, but somehow the free cash flow is always very low and it's not really increasing much, then it means that they are channeling the money from the income to somewhere else. You may not know. Okay, I repeat again, when you check for FCF, okay, also check for net income. Is the net income increasing and does it correspond to an increase in the free cash flow? If a lot of times it is not, then they could be up to some funny business also. I say could be, not necessarily. So that's why you need to go into the financial statement and see where did the money go. Yes, it could be for R&D. If it's for R&D, they want to open up a new branch, all right, then it's possible. Patricia, how is it possible when everybody loves McDonald's? Okay, they are borrowing a lot of money just to do share repurchase. Simple. Okay, if I were to summarize everything, yeah, they are earning money, but they are also trying to they are very desperate for share repurchase. I don't know why. Okay, so they are really borrowing a lot of money just to do share repurchase. To me, this is no good. This is quite bad. Okay, that's why I want to buy the burger, but I don't want to buy the share. Yeah. Correct, Jun Jie, you're right. Okay. Okay, Veronica, yes, McDonald's, they have a lot of assets, they have a lot of restaurants, they have property, equipment, okay, but the financials are not nice. All right. So I don't care how much property they have right now, they have more liabilities. That's all I need to know, and that's really the thing stopping me from going into McDonald's. Okay. So far, okay, these are the 4 main ways how you spot a cheater. So if this makes sense, okay, can you type make sense? So what's the lesson from here? It means you don't see things as a singularity. You don't see free cash flow as free cash flow alone. Okay, as you get better and better at looking financial statements, right? Try to form a picture. Try to form a story. Okay, look deeper into their relations. Very good. You may want to even look into their revenue. Okay, yes, very good. Don't look at the surface. Go in deeper. All right. It is very, very. Will I sell at McDonald's? No, I don't own the shares. Okay. All right. Yes, really dig deeper. Yeah, and even Morningstar, okay, will give you quite a lot of information already. Okay, so far okay. If yes, then I will go into the other parts of the fried snake. Thank you, Gavin. All right. Maybe I'll just put this slide here for maybe 20 more seconds. Anybody wants to take a screenshot? You can take a screenshot. Oh, okay. So actually, no. Sarah says we will post this in OMM. Yes. Okay, I forgot about it. Yeah, this is video recorded. Okay, so much for McDonald's. I feel like eating McDonald's, but never mind.
You just ate KFC yesterday.
KFC is KFC, what? Okay, so, okay, right now, we are going into something, that all of you hate. Okay? We are going to something that all of you hate. Okay, that is the financial report. Okay? We are going into the financial report. So
people say they're brain fried already, still want to go into financial report.
Brain fried already. Okay. Oh, Gordon says, oh no. Everybody says, oh no. Okay. You can eat McDonald's while reading the financial report. Okay. Okay, don't worry. I know you are brain fried. I know your eyes will go blind. Okay. I know whenever I ask students to go and open up the financial report, you'll say, oh, sorry, my eyes are blind already. Don't know why I cannot see. Okay, no problem. I am really going to help you. I am going to help you to filter this out. Okay, there is a shortcut. Okay, but okay, let me say this. The shortcut can only get you so far. I rather you read it properly, then you learn the shortcut. Okay, I repeat, I rather you learn how to read the financial statement properly, then you learn the shortcut. But I will still show you. Okay, I will still show you. Okay, but this is just to show you. Okay, can you give me a financial statement that you want to look at? Berkshire, Visa, Zoom, has a lot PayPal. No, Visa. I'm preparing something for Visa. I'm going to share about Visa after this course. So I think it's mind blowing. Okay, maybe I'll just go to something that I'm very familiar with. FB. Okay, why? Because like I said, I'm trying to show you something. So okay, thank you. Okay, so what I do is I could just go to Google. I just put FB 10K report. Okay, FB 10K report. Okay, what's the difference between annual report and 10K report? Okay, what does 10K mean? Okay, 10K is just the code name for the report, for the particular report. Okay, there are slight differences. The annual report will contain things like CEO notes, CEO greetings. Maybe they will put the qualifications of the CEO, things like that. Because it's the annual report, it's supposed to be given to investors. They want it to look a bit nicer. The 10K report is actually a shortened version. Okay. Yes, every company just Google so and so company 10K. Okay. 10K is a report, yes, that the company need to submit to the government. So the government is not interested. What is the qualification of CEO? They don't care. All right. You just give me the 10K report, give me what I want. That's it. You don't tell me anything else. All right. And the nice thing about the 10K report is almost every report, the format is almost the same. Why? Because this is a document they have to submit to the government. And the government makes it, such that the company must submit the report in that particular format. All right. US government, yes, US government. Okay. So yes, 10Q is for quarterly. Okay. So for companies, foreign companies, okay, that are listed in New York Stock Exchange, okay, you cannot find the 10K. It's called 20F. Okay. You may want to note this down. For foreign companies like Alibaba, okay, Tencent, okay, Tencent I haven't searched, but Alibaba definitely, you can never find a 10K report. Okay, instead of 10K, just put 20F, 20F. All right, for US companies, 10K. So usually what I do is, okay, I will look at, okay, the fourth quarter one. I'll look at the form 10K. Can you see here? Form 10K. I'll click on it. Now I wait for it to load. Okay. Over here, there's a PDF. I love the PDF format. Okay. Yep. Go to their own investor relations website, either 10K or 20F. All right. I love to make it big. Okay. Can you see the content page? The first page I always go to is always the content page. All right. Can you see over part 1 over here? This explains the business model of Facebook. The second part tells you all the risk. So just now there was somebody, right? You say you don't know how to interpret the risk, all this thing. It is all here. All right, Christopher, you cannot determine the risk, whether it is science and tech, key person, or all. It's all here. All right. So let me just look at the business first. Okay, wait. Okay, the first part is risk. So I will go to risk first. You want to go to the business first? It's also all right. But I just want to go, from top down. So I will look at the risk first. Okay, so I just click on risk factors. Can you see all the risk factors it's all up? Okay, I'm scrolling quite fast. Okay. The most important parts they actually bold it for you. Okay. The most important part, they actually bold it for you. You see this? Okay. They tell you Facebook tells you straight away, if they fail to retain some existing users or add new users, blah, 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 blah. Okay. Just read this. If you don't understand, then you read the elaboration. Okay. For those more hardworking ones, you don't mind going deeper. Okay. You really want to go deeper. Okay. You can really read through the elaboration. All right. Okay, Xuan, what's the difference between 10K and 10Q? 10K is the annual report, 10Q is a quarterly report. So every year they have to submit 3 or 4, I can't remember, 3 or 4 10Q, all right, and 1 10K. Bernie attempted to read Nikes, read until my eyes hurt. Good, good. This level of pain is good, really. All right, the 10Q, yes, correct, thank you, thanks Pete. 10Q will not give you all the risk and the business. Only the 10K. Yep. Correct. So let me show you my cheats. Let me show you my cheat code. This is something that you are very, very excited. Okay. Correct. Okay. I already put R&D already. Okay. How I search whether it's science and tech. Okay. For those who are totally new, right? Let me explain what is a science and tech risk. Okay, if your company always has to be on top of the innovation chain, they have to come up with the latest technology. then there is science and tech risk. Okay, I give you an example. Fujifilm versus smartphone and digital camera. Okay, I repeat, Fujifilm versus your smartphone. Why did Fujifilm, Kodak go out of business? Because they didn't, they couldn't keep up with technology. Okay, so for a company that has a lot of science and tech risk, they have to spend quite a lot of money and effort and time to do R&D, okay, to keep up. And even then, just because this company does a lot of R&D doesn't ensure that this company is successful. You can do a lot of R&D, but nothing comes out. This is a fact of life. All right, those who went to do final year project in your university days, you will know. All right, you can spend one whole year doing FYP, but you don't know what you're writing. Okay, so to check whether Facebook has R&D risk, okay, or science and tech risk, okay, this is one function that I want everybody to know and be very familiar with. Go to the financial report, Control F. Control F will be your best friend when it comes to financial report. Okay, how I do it? I will search for research. Okay, research. I will just scroll down. Then I'll try to see whether they have to do a lot. Okay. Okay, you see, they have to do now. I know they have to do research and development. That means I know no matter what, they have some form of research or science and tech risk, some form. Okay, don't believe. Go down some more. Go down some more. Go down some more. Okay. Where is it? Sorry, because I'm opening a lot of small boxes from Zoom. I cannot see where am I. Okay, go down some more. Blah, blah, blah. Let me see. Let me go to table of contents first. Risk factor. Does it say research? You see? Over here. If the users adopt new technologies or their competitors adopt new technologies, then they are at risk. It means that, yes, they need to stay on top of the innovation chain. They must be one of the top. If not, it is very easy for the users to just be disengaged. Okay, so for Facebook, do you think they have science and tech risk? Yes or no? Yes, right? Yes, okay. So if they have, okay, please remember for the purpose of this checklist, if they have the risk, okay, you must put -1. Okay, you must put -1 if they have the risk. If you don't have the risk, put 0. Okay, I repeat, if you have the risk, put a -1. If you don't have the risk, put a 0. All right. Okay. Okay, the net margin, I'm going to skip for a while. Okay, I'm going to come back to it later. I'll go to authority risk. Okay, what is authority risk? It means the government, from time to time, they will come up with laws and regulations, okay, to really affect the business of Facebook. Okay, so do you think Facebook has authority risk? Yes or no? Yes. Okay. Yes. Recent news. Okay, huge. Okay, good. So how do you ensure that how do you find this in the financial statement? What I do is, my favorite cheating again, I just type regulation. Okay, can you see the first one? There are changes mandated by legislation, regulatory authorities, or litigation that adversely adverse our product and users. Yes, so just type regulation. Yep, it will come out. Okay, then you can focus on the areas where regulation appears. The other one, see, government regulation. Straight away, we are subject to blah, 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 blah. So now straight away, I know Facebook has authority risk. They are subjected to government regulation, which may affect their business. Okay? Okay, the last one, key person risk. Okay, what this means is that, is this company doing very well because of a few key person, either one or a few. For example, the main key persons risk for airlines, okay, usually they are the pilots, because if the pilots go on strike, that's it, the airline cannot fly, the airline won't be able to make money. Okay, so similarly for hospitals, if the surgeons, the doctors, they go on strike, all right, this hospital very likely they cannot function. But if McDonald's, the workers go on strike, do you think McDonald's care? Or KFC? No, yeah, because they can just hire anybody to take over. Maybe they just have to pay a little bit more, people will come and work. Okay, so this is what I mean by key person. It does not have to be the CEO, all right? But for Facebook, do you think there is, can I just check, do you think Facebook has key person risk or not? Yes or no? Yes, Kelly says yes. Yes, some say yes, some say no. See, this is very subjective. Huh? Let's see. Okay, don't sit there and guess. Okay, over here. Okay, see, this is what Facebook says. Yeah, so does Facebook has key person risk? Yes, so no need to argue already. Facebook itself thinks that Mark Zuckerberg is a key person risk. All right. So right now, you see that Facebook almost has all the risk. Okay. When there is the risk, remember, put -1. So if you put +1, your scoring will be screwed up. Okay, it will be totally affected. You go haywire. Okay, just check whether you have inputted the negative sign properly for your risk. All right. So what is this inferior net margin? Let me just explain. I'll go to Morningstar for this. All right. Over here at Morningstar. Okay. Can you see, if you scroll down in Morningstar, you'll see this tab called competitors. Okay. Click on competitors. Okay. This one shows you what are the possible competitors of Facebook. Okay. There's Google, there's Snapchat, and what else? There's this Verizon. All right. So, okay, how do I do this? So I will have to check the net margin of each and every competitor. Okay. I have to check the net margin for Facebook. I have to check the net margin for Google. If Google's net margin is the highest, okay, then it is a 0. Okay. If Facebook's net margin is not the highest, I will still put a -1. Why? Because I want to see, okay, in this competitive industry, in this industry where these are the main competitors, okay, is Facebook the most efficient? Is Facebook the most profitable? And I can see it, okay, in this metric called net margin. Okay, so can you help me to go to Facebook and let me know what is the net margin of Facebook? Okay, so to check this, for those who are unsure, click on key ratios data. Okay, go all the way down. Net margin is over here. I'm interested in the TTM. Okay, for Facebook, it is 28.57. Okay, so maybe I'll just put here, for Facebook is, Facebook is 28.57. Okay, can someone help me check for the rest? Okay, the rest of the competitors, Google, maybe some of you check Google, some of you check Snapchat, And some of you check Verizon. Okay. I need to drink some water. Okay, Yanqing, thank you. Google is 20.71. Okay, I'll assume this is correct. Okay. VZ is 14%. 14. How about Snapchat? Snapchat is 55.4. Okay. I remember seeing something about Snapchat. Wait, let me. Minus. Oops. Sorry. Okay, so we know Snapchat lose already. Lose big time. Okay, the next one is -3. So does Facebook have the, oh, okay, Nita, where do I go again? Okay, let me just show you Facebook, full key ratios data. Okay. Under this tab called profitability, okay, all the way down, this is the net margin. Okay. This one above the 1, 2, 3, 4. 4 rows above ROE. Okay. Yeah. So I'm interested in the TTM. Okay. So over here, does Facebook have the strongest net margin? Yes or no? Yes. Okay. So do I put 0 or -1? Great. So we put 0. All right. So for Facebook, we know, okay, among all the similar players in the industry, okay, it is the strongest. It is the most profitable. Okay. So I will assume that there is something that Facebook is doing better than its competitors. That's why the margin is so high. Okay. Okay. So any questions on the risk part? Any question on the risk? Okay, if it's good to go, just put good, and I'll continue on to economic mode. Yes, so it's only -1 or 0. Okay, good to go, good to go. Yes. I'm trying to show you all the cheat code now. Adi, don't. Kelly, okay, for all tech companies, they have science and tech risk. Correct. So yeah, they have. So -1. Okay. KG, what do you mean? For Google, it'll be a 0. Okay. If I'm checking on Google, okay, Google is 20.71. So Google's net margin, okay, is not as strong as Facebook. So I will put, let's say if I'm doing for Google, it will be a -1. Okay. Okay. So what do you mean? How effective categories as compatible? What do you mean? Sorry. Yes, Christopher, you are correct. You may, when you are doing Google, okay, the competitors may be slightly different. Okay. So you can just go and check. All right. Okay, then I'll move on. All right. So we have talked about the risk. Okay. Are they in the same field? Okay, I don't think they are in the exact same field, but there are a lot of things that they are doing similarly. For example, let's say Facebook, they are competing directly with Google, especially YouTube, for the audience attention. Because how they make their money? Facebook make money from ads, Google, same with Google. Okay. So right now, I think Facebook, they have quite a dominant market share. Also YouTube. YouTube is the same. So they are really competing with each other to see, because if I'm a company and I have enough money just to put advertisements on one platform, I will have to choose between Facebook and Google. So in this way, they are direct competitors. Okay, I hope it answers your questions. Okay, Yuksun. Okay, so if there are no more questions, okay, I will go into the economic mode. You can think of economic mode as strengths. Okay, we have talked about the potential weakness of the company. Now we want to analyze their potential strengths. Okay, there are a few strengths. Okay, intangible assets, low cost advantage, high switching cost, network effect. Okay, yeah, and efficient scale. All right. So, okay, the competitors part, right? Do remember that this is Morningstar's analysis. Okay, can you see this? Morningstar's analysis. They may not be totally accurate, but I think, okay, as a start, I am comfortable with using what Morningstar recommends, okay, to really compare their net margin. Okay, so far, okay? Okay, these are Morningstar's analysis. So, whether they are exactly the real competitor or not, I also don't know. All right. How many competitors to compare? Usually, Morningstar will give you 3 or 4. Okay, so it's not too much work. Of course, if you read through the financial statements and you find out, hey, this is also another competitor, you can use that also. All right. Okay. Now we come to the economic mode. Okay, the strength. Okay, so intangible assets, right? Okay. They refer to the branding, they refer to the copyright, the trademark, patents, and licenses of a company. So for companies that have all these things, naturally their branding, their intellectual property will be protected. So this is definitely a strength. So how do I find this very fast? Okay, in fact, I already helped you already. This is what you control F. This is what you search for. Brand, copyright, trademark, patent, license. Okay. Yep, you can look at balance sheet, okay, and you can also look at the financial statement. I love to look at the financial statement. Okay, I'll just search for maybe patent. Straight away, this thing comes out. Okay, to establish and protect our proprietary rights. It's here already. So, does Facebook have intangible assets? Yes or no? Yes, very clear. Okay, super shortcut, right? Okay, if there is this mode, okay, I repeat that if there is this mode, put a 1. Okay, put a 1. So don't put -1 now, put a 1. I already say already. Okay, for the risk, okay, if there is a risk, if there is a presence of risk, put -1 points. Okay, for the mode, if there is the presence of the mode, put +1. Okay, so be very clear on this. If you don't put this well, your whole scoring system will go haywire and then you'll come and ask me. Okay. Okay. This one. Okay. Low cost advantage. What does this mean? Okay, Shen, if you refer to balance sheet, right? Now I realize, right, the balance sheet is not so, it's not as, I think if you were to only look at the balance sheet alone, right, it's not so good. Why? Because balance sheet, they have this thing called intangible assets, and they will roughly just allocate a value. They will just assume a value for the branding and just put in a money value there. But how do they come up with the value? Nobody knows. So right now, I actually prefer to go into this kind of statement to see whether they have that protection or not. Okay, Chris. Okay. Goodwill, no, not now. Okay. Yeah. All right. Okay, so the other one, low cost advantage. Okay, this one is not so direct. This one you cannot just Control F, low cost advantage, and then, oh yes. Why? Low cost advantage means they are able to buy their supplies at a lower cost compared to competitors. Okay, companies that usually have this kind of advantage will be your Walmart, your mega store, maybe your Costco, your Kroger, all these things. All right. So, or maybe Nike. Okay, maybe. But I realized something after reading through so many financial statements, right? No company ever says that, oh, I enjoy low cost advantage. Why? Okay, imagine they say the next year their suppliers will charge them more. Yeah, no company ever says we have the ability to enjoy a low cost advantage from our suppliers. Next year should die. Okay, so how do you do it? Number one, you need to understand the business. Number two, okay, you may want to compare between the operating margin, okay, or the gross margin. Again, this is almost like how you compare the net margin, but this time around is operating margin. What does operating margin mean? It means the margin coming from your day-to-day operations. All right. So where do you find it? It's actually over. Okay, Daniel, sorry, let me just repeat. You can refer to the statement here. If there is a risk, put -1. If there is a mode, +1. Okay, if don't have, 0. Okay, no problem. So how do you check whether they have, in a way, low cost advantage? Okay, I usually do it by comparing their operating income. Operating margin, sorry. Okay, this is their margin from their day-to-day operations. Okay, this is the same way how you compare the net margin. Okay, Facebook now is 36.2. Okay, yes, it's very high. Yep. Can someone help me check for Alphabet? What else? Snapchat, Verizon, the competitors. Okay, Snap is -57, right, Bu Kyung? Minus, right? Okay, thank you. How about Alphabet and Verizon? Google is 21.4. Verizon is 22. Okay, so is Facebook the king again? So, yeah, yes. So Facebook is the champion again. Oh, this Facebook cannot stand it, always win. Okay. Yeah, David, you're right. Companies give their branding a monetary value, so they classify this under intangible assets. All right. Okay. Hadi, bye. Not now. Quite high the price. Okay, must wait. All right. Okay, high switching cost. What does high switching cost mean? Okay, so now we know, in a way, when we compare the margins, Facebook has a low cost advantage. So for high switching cost, it means that it is actually very painful for the customer or the user, whoever uses that product, it is painful for this customer to switch to the competitor. Oh yes, Nita, you're right. Operating margin, higher the better. Okay, all margins should aim as high as possible. All right. Okay. So for high switching costs, I repeat again, it means, okay, it is very painful for the customer or the user to switch to their competitor. Case in point, your Adobe, your Microsoft Word. Okay. For me to switch from Microsoft Word to another word processing software is painful. Why? It means I have to relearn. It means that all my previous data on Microsoft Word gone. Okay. Open Office. Yeah, I hate Open Office. All right. Yeah, some people from iOS, very difficult to switch to Android. Okay. And I also found out that high switching costs, they won't put it in under their business model because they are all very scared of losing these potential customers. So they are always trying to innovate and make it better. Okay. This is one mode you almost cannot. I've never found it in any financial statement. So this one, you will have to use your own understanding. Okay. So to you, does Facebook have high switching costs? Yes, all your friend is inside. Yes, very good. You want to stalk your friend, you leave Facebook, you cannot stalk your friend anymore. Okay. Vivian, for low cost advantage, yes, operating margin. Okay. You can check either one. I'm okay with either one, but operating is the day-to-day. So therefore, I tend to use operating more. All right. Oh, Wei Yang said no, plenty of social media. So now I know what you do to stalk your friends. Okay. Yeah, the younger ones will say no. Okay, so you all say Facebook has high switching costs. Oops. Yeah. So don't forget, you want to stalk your friend on Instagram, it's still Facebook. All right. So far, okay? If it's okay, can you please type okay? Okay, great. Okay, network effect. Okay. So over here, I put MAU. Check for MAU. What does MAU stand for? It means for monthly active user. You can check for daily active user, also can. Okay. For companies with network effect, they are very anal. They are very particular about this monthly active user. Because if there's a drop in the active users, it means that they are not engaging it's their KPI. The mood will be super pessimistic. Correct. Okay. So what does network effect mean? It means that this product or this service, the value increases when there are a lot of people using it. For example, your matchmaking apps, your Tinder. If there's dating app A and dating app B, dating app A only has 100 users, 100 people sign up on dating app A. But dating app B, there are 10 million. Okay, will you use dating app A or dating app B? Use both. For Hardy, very good. I like. Okay, but normally, no user is not desperate. I think he's resourceful. Okay, very experienced. Yes. Okay. Back to the question. So if dating app A only has 100 users, dating app B, Wei Yang says B. Okay, correct. You have a wider pool of people to choose from. Okay, this is called network effect. Okay, dating app B doesn't have to advertise, just by virtue of fact that I have 10 million users. Look, everybody will want to sign on. Everybody will want to create an account there. Okay, I think Meng Chun asked a very good question. What's the difference between operating margin and net margin? Okay, Meng Chun, operating margin is the margin based on daily operations, daily activities. Okay, net margin, it considers dividend payout. Okay, dividend payout is not day to day. It considers income tax. It considers your other expenditure. Okay, the non-recurrent ones. Okay, I hope I answered your question. Network effect also be diversified revenue streams like Disney. I will not think so. I will not think so. Okay, another company with a very strong network effect is actually our favorite Alibaba. Okay, so how does Alibaba network effect work? Okay, they somehow they attract all the merchants. When there are a lot of merchants advertising their products on their Taobao or Alibaba website, what happens is the customers will want to go to Taobao also or their website also. And when there are more customers, the sellers will also want to come in. So this is like a never-ending loop. Okay, it just keeps building the company over and over again. Yep. Okay, Ming Yi is asking, how come higher operating margin means low cost advantage? Okay, Ming Yi, remember, operating margin is the margin from the day-to-day activities. If I can have a higher margin, it means that somehow I'm able to get my supplies at a cheaper, or I can price it more expensive. In this way, anyway, there is an advantage. Okay, for Sam, does network effect only apply to e-commerce? So far, I cannot think of any other example, so I will say yes. Okay. Yeah, e-commerce, mostly online platform. Okay, I can never foresee Walmart having network effect. Netflix, MLM, I don't know. Netflix, actually Netflix, I don't know. I really don't think so, because I will just ask my friend to share their password with me. Please don't. Oh no, this is recorded. Okay. Okay, Christopher, sorry, Stanley. The difference between McDonald's and Yum, you're talking about branding. Okay. Ken, you're right. Yeah, they do have network effect because all your friends are there. Okay. Gaming, yes. Gaming, yes. Gaming, yes. All right. The difference between branding, they have to spend a lot of money to go and create the advertisement. People need to watch, and then they are attracted to use the product. Okay. Network effect, no. Just by virtue of fact, they have a lot of people there. They may not even need to spend a single cent on advertising and marketing. Okay. So Facebook, yes, there is network effect. Okay. Oh yeah. How come it always makes me type here? Okay, let me just show you over here on the control on the search. Okay, I just type monthly. Okay. No. Here. I just type this m.a. Oh no. See? Once I type in the word monthly, right? You see, they really track this very, very diligently. Okay, daily active user, monthly active user, average revenue per user. Okay. Apple, Apple, does it have network effect? I am not sure. Okay. This is, I think, to me, this is quite subjective, and I haven't searched the financial report hard enough. All right. Okay. So, yes, for Facebook, there is a network effect. Okay. So I put 1. Okay. So the last one, efficient scale. What do I mean by efficient scale? Okay. It is when this particular company, all right, their industry is so niche that it doesn't make sense to have too many companies inside the industry. An example is your weapons manufacturer. Okay, one very famous one is Lockheed Martin. Okay, you think about it. For a weapons manufacturer, right, you can only sell to 2 groups of people, either the governments or the terrorists. No other people will actually buy weapons. I'm talking about weapons like missiles, fighter planes and warships, and cannons. All right. So, okay, if this company, that particular company, yeah, SGX is one. Hadi, you're right. SGX, it doesn't make sense to have a second SGX. Vicom, maybe, but Vicom has a competitor. Intel, AMD, no, I don't think so. Okay, I don't think Intel and AMD has an efficient scale, because seriously, if another person want to open another company selling all these computer chips, can it be done? Yes. All right. Yes, BA and Airbus is under efficient scale. Yes, because seriously, only airlines will want to buy the airplanes. Nobody else. TSM, I'm not too sure. Okay. If another company really wants to do it, maybe they can. Okay, so Gordon, if you check Morningstar, there's no competitors. If I haven't tried this. Okay. Yes, if you cannot find any competitor, then definitely it's efficient scale. Okay, but for efficient scale, you really need to understand the business model quite well. Okay, Pile says telecom. Okay, high barrier to entry. Yes. It's another. Yes, correct. Nita, you're right. Okay, telecom, I'm not too sure, because maybe 20, 30 years ago, I would say in Singapore context, yes. But now we see a lot of other telecoms like One Republic, Circle Life, all these things. And the number of companies start to increase already. So I will not consider a telecom having an efficient scale. Okay. Alex, if you're not sure, better to put 0 than 1. Correct. If you're not sure, just put 0. Okay. So does Facebook has an efficient scale? I don't think so. So I'll just put a 0. Okay, so far so good. we are done with risk and the economic mode already. Okay. Okay, Winston says good. If you're good, can you please say yes or good so that I know I can continue? Okay, we are approaching the break. Three more things only. 3 more things only. Okay, hang in there, hang in there. Yeah. Great, great, great. Okay, increasing revenue. I think this one you should know where to search for already. Okay, very easy. Just go to Morningstar. Just look at the revenue. Okay. All right. Wow, thank you, Bukyong. Okay, just look at the revenue. Okay, if it's positive and consistent, 1 point. If it's increasing over the years, 2 points. If it's not, yes. I think you guys are so familiar with this now. Okay, so increasing revenue is 2. Okay. Okay, retained earnings. How can you, what is actually retained earnings? Okay, let me explain this. Retained earnings is really all the money that they have left after paying their tax, their dividends, every single thing. Okay, this is really the extra money left behind every year. All right. So this is what we mean by, no, this is not net income. Net income hasn't taken into account the capex. Correct, accumulated profits. Okay. Free cash flow, okay. No, free cash flow haven't taken into account the income tax and dividend. Okay. This is accumulated profits. Okay. Chin Chin is not so much on net profit. Net profit is net income. All right. Yeah, Ryan is right. Accumulated profit year after year. Okay, that means let's say this year, after paying for everything at the end of the year, December 31st, I have $1 million left. So my retained earnings for this year is $1 million. Next year, let's say my business gets a lot better. My leftover earnings is actually $3 million. So now my retained earnings is $4 million. Okay, so it is really the earnings that is left from previous year and previous year. Net income is usually every year. All right. So how can you find these accumulated earnings or retained earnings? Okay. Can you look at the screen? Okay, this one must see. If not, you'll be lost. Okay, click on financials. Click on financials. Okay. Go to balance sheet. Okay, click on this balance sheet. Click. Okay. Retained earnings is all the way at the bottom. Can you see this? Retained earnings. All right. If it doesn't have any data, just scroll it to the right. All right. If it looks blank here, don't worry. Scroll all the way to the right. Okay. Can you see? Yes, Bernie. Financials, balance sheet, then retained earnings. Very good. All right. Can you see accumulated earnings here? For Facebook, okay. First year was 9.79, then 21, 33, 41, 55. Okay. Very clearly, for retained earnings for Facebook is 2. Very clear. All right. Okay. So far, so good. Okay. Share repurchase. This is the more tricky one. Remember what I said about share repurchase earlier? If this company is doing share repurchase, is it a good or bad thing? Is it a good or bad? Wow, very good. Very good. All of you know already. Yeah. So, when is it a good thing? When is it a good thing? When the company has a lot of money, very little debt. Okay. Okay. For Facebook, okay, do they even do share repurchase? Very easy to find out. I think you all should know by now how to cheat code, the cheat code. Just Control F, share repurchase. Okay. Yep. So Facebook also does share repurchase. Okay, and there is one more trick that I want to show you for share repurchase. Okay, let me show you. Okay, can you see this page? All right. So we know that in 2019, okay, Facebook bought back its shares at an average price of 202. Okay, so what this means, you can even use this as one data point for valuation. Okay, it means that actually Facebook internally, they evaluate their own shares at 202. Okay, so if it drops below 202, is it a good time to buy? Yes, it is a good time to buy. Okay, it is a good time to buy. So for Facebook, they do share repurchase. All right, do you think for Facebook's case is good or bad? Will you give 1 point or 0 point? 1. Great. So okay. Oh, we are finally done with the whole fried snake. Okay. So can you see Facebook? What is the average score? What is the average score? Okay, 8.125. So we can say it's 8.8%. Okay. So it's not too far away from your fried alone. Okay. Yeah, portfolio sizing 8%. Good, Gordon. You are catching on very fast. Okay. So any other questions? If no questions, can you all type a good or okay? Okay, Okay, so right now, what's the time?
Okay, can I actually come in now?
Okay.
Okay, if you all actually understand whatever that has been gone through, can you all type fried snake? Fried snake. I see people asking what is snake already. What does snake stand for?
What does snake stand for?
Actually, yeah, what does snake stand for?
Okay, S is size and tag.
Okay.
N is net margin.
Okay.
A is authority.
Okay.
K is key person.
Okay.
And the E is economic mode.
Oh, okay. So that's the snake lah. Okay, by the way, actually snake in eating fried snake in the Chinese context, right? Do you all know what does eating snake stand for or not? In Chinese, in the Chinese context. Slacking, being lazy. Okay, so right. Why is it that we want to have this fried snake is because when we do our homework, okay, and we invest in good companies, these good companies can then earn money for us and then we can slack. All right, this really is the ultimate passive income strategy. Passive income strategy. Okay, so right, actually today, right, we actually covered quite a lot already. So what I want to do is I want to actually consolidate and I want to answer to some of the homework that you all have already done, which was really very good. Okay. Yeah. Okay. Okay. Actually, we have already been going for 1.5 hours, right?
Yeah.
Okay.
Break.
Okay. So I tell you what. Okay. Let's go for a very quick
15
minutes break or 10 minutes.
You want 10 or 15?
Okay. You want 10 or 15 minutes break? You all let me know. Then I will go through homework after this. Okay. 10 minutes break. Okay. I think most people. Well, some people 5. Okay. So I'm gonna set a 10-minute timer. Okay, for you to go to the toilet and all that. Okay. So after we come back, right, I'm going to go into detail on the homework that you have done. Okay. Because it was very, very good work there, and I think there are a lot of learning points from there. Then we are going to do a summary, and then you will have more homework to do for tomorrow. Okay, must practice. Very important. Practice. Okay. So, okay, 10 minutes. Okay, please go to the toilet and freshen up yourselves. And when we come back, we'll go through your homework. All right, 10 minutes. Okay, let's go. Okay, I've recorded. Okay, welcome back. Okay, so we're going to consolidate what we have learned today, right? Okay, so the two key things we talked about was actually how to find whether it's a good business or not. Okay, and then how to do the valuation. Okay, so in the morning, can y'all tell me what did y'all do to find out whether it's a good business or not? Can y'all tell me? Okay, what was the acronym that y'all used in the morning to find out whether it's good business or not? Okay, y'all actually use. Okay, fried. Okay, so over here, level 1. Okay, level 1, we actually use fried. Okay, fried. Okay, and then based on the fried score, okay, based on the fried score, we actually also do portfolio allocation based on percentage. Correct? Okay, so this is level 1. Level 1. Okay, then we actually went deeper in the afternoon where you all really became fried snakes. So level 2, we actually looked at the entire fried snake in totality. Okay, Joe, do you manage to cover with them the portfolio allocation portion?
Yeah, they know already, ma.
Based on fried snake.
Yeah, they know already. They put allocate 8%.
Okay. So very good. Okay, so if let's say fried snake is too much for you. Okay, so let me just show you this one. If fried steak is too much for you, you can just go with let's say fried. Just now, what example do you do, Joe? Facebook is it? Facebook. So this is actually Facebook lah. Let me rename this. Okay. So so at the very basic level, okay, what we actually want you all to do at least is the fried. Okay, so that you can actually have a sense of the portfolio allocation. All right, and okay, eventually we also want you to progress, right, to be able to read financial reports. And Joe has already very kindly created a lot of shortcuts for all of you. All right, okay, and based on that, if you do the entire fried snake, okay, the entire score is scored upon 10. Okay, so actually the full score is 16 lah. So he has re-weighted it until the full score is 10. So if you do analysis based on fried snake, can you tell me what is your portfolio allocation for Facebook if you do based on fried snake? What's your portfolio allocation? Okay, 8%, for example. Okay, so okay, if let's say you are at level 1, you can just do fried and then get your portfolio allocation. If you're at level 2, okay, you can do fried snake and do your portfolio allocation. Regardless of what, you need to at least have the good business portion. Okay, let me see. Is everybody admitted already? Okay, is everybody admitted? Okay, so next one. Okay, so in the morning, we also talked about valuation based on PE. So we did valuation based on PE. Okay, based on PE. Okay, and then we actually take a look at the PE ratio. Okay, so from this, we actually derive what is the undervalued. Okay, what is fair value and what is overvalued. Okay, this is based on level 1. Okay, and we actually also made it optional. So important, optional. Okay, basic TA. Okay, so that you can get more exact entry. Okay, so this is all based on level 1. Okay, so then after lunch, when we came back, right, we actually did a level 2 PE valuation. Okay, what do I mean by level 2? Because we actually became more nimble. Like for example, you looked at Coke, okay, and Coke was actually undervalued at a lot of levels, so it was a bit strange. So we took a look at the EPS history to find out which was the EPS we wanted to use. Remember, we all modified it to 1.5. And we also took a look at the PE history to see what actually made sense in terms of fair value and undervalue. Okay, right. So this was actually what we covered for the whole of today. Okay, and based on this, right, I want to actually go through some of the homework that you have given. Okay, so this is actually some feedback that I have. Okay, so generally all of you have applied fried very well. I think all of you understood how to actually look up these things from Morningstar. Okay, and then you also managed to show very good application of PE ratio valuation and basic TA. Okay, but what we didn't see very often, right, was that you all actually didn't really put in your portfolio allocation and cash. Okay, so like for example, when we went to the homework, right? Okay, like for example, actually not just Pile, like actually many of you, okay, you actually have very detailed entry prices and all that, but then there is no you didn't show us your portfolio allocation and you didn't put down your cash also, or maybe it's too small, we couldn't see. Okay, so do remember that the portfolio allocation and cash part is very important, because this will then lead on to tomorrow's segment on what strategy can you use. Okay, so right, basically, if let's say you know, for example, let's say Starbucks, for example, Starbucks, okay, I'm supposed to allocate 6%, right? Okay, based on my fright score, for example, and my portfolio cash is 3,000. Okay, can you tell me, can I do a sell put for Starbucks? Yes or no? Yes or no? Can I do sell put for Starbucks or not? Yes or no? Okay, if I want to do sell put on Starbucks, can you all tell me, okay, based on the current share price, if I want to do sell put for Starbucks, right, how much do I need? Around what? How much money? I need 7638. No? If let's say I want to sell a promise to buy 100 stocks at the current price. So it's already out of my portfolio, can you all see? So it is very important for you all to, based on the fright snake score or the fright score, okay, put in your portfolio cash so that you know basically what kind of strategies you can do. Okay, so over here it's very clear already. I can only, for example, buy stocks, or I can maybe buy. Can I buy a call or not? What do you all think? Do you think I can buy call? Okay, I can buy call, right? Right? Okay, so I hope that you all see, right? You actually need to first do your company analysis. Okay, then after that, based on the company analysis, then you need to go and do your portfolio cash. Based on portfolio cash, then you come up with a strategy. Not the other way around. Not strategy first, then you think of portfolio. It should be portfolio first, then your strategy. Okay? All right. So, and then after that, based on your whatever entry price that you have, you can actually put this in so that you actually have a clear sense of how many shares you can buy and what kind of strategy you can use. Okay, somebody was asking whether I can do a sell call for Starbucks. Okay, if I want to sell call for Starbucks, how many shares do I need? Can you all type it in? How many shares do I need? 100 shares. So how do you think I can do a sell call for Starbucks? Yes or no? I cannot do a sell call for Starbucks. All right. Okay. So now after today, right, I will actually need you all to do some homework. I need you all to do some homework, okay, to make sure that you all actually have this in place so that tomorrow when we go through the income strategy and the exponential growth strategy, it will actually make more sense. Okay. With strategy X plus will be a mix of buy call and sell call. Okay, so your base is you need enough money for buy call, so it is still possible. Still possible. Okay, Alex Wong, would you advise us to do sell call and buy share at the same time? Okay, if you do sell call as a stand alone, you need 100 shares. So you cannot do that. Okay, so you cannot do that. Okay, so anyway, I wanted to use this point to point out to you that this portfolio allocation is very important because this will then tell you what strategy you can use. Okay, okay, so for these people whom I have actually commented on homework, if your portfolio allocation is missing, okay, for your homework after this session, please make sure your portfolio allocation is in. Okay. All right. Okay. Some people regret using strategy X. Okay. All right. Okay. So second thing, this is the key thing that I actually want to address: being nimble with your PE ratio valuation. Okay. So these are some companies that I saw that the valuation looks a bit outrageous lah. Okay. So for example, we have Disney. Okay. So I think we actually, okay, let me show. Okay, so for example, I think Rebecca, you did this, right? Okay, Rebecca did this, and based on the PE valuation, realized that how come all the prices are way below the current price? Correct? Okay, how many of you did Disney? If you did Disney, can you type DIS? If you did Disney, can you type DIS for your homework? Okay, so this is very strange, right? Okay, so let's just actually do this together lah. Okay, so right now we want to do the okay, so this is assuming you did all the fright and all that already. So I'm just going to go through the PE valuation part. Okay, so the important thing is we practice as a community. Okay, so we have undervalued, okay, fair value, and overvalued. Okay, so let's take a look at Disney. Okay, we did fright already. Rebecca, what's your fright score? Can you type it in? Okay, so Jin E, okay, you got 9 for Disney, okay, 9. Okay, Rebecca got 8. Okay, so it doesn't matter 8 or 9. Okay, what's the implication of it? So 8 or 9, the implication is that you will just allocate accordingly for your portfolio. So Rebecca, okay, you will allocate 8%. Okay, then Wei Yang and Jin E, okay, you will allocate 9%. Okay, so up to your own risk profile. Okay, so right now we are taking a look at Disney. Okay, so let's take a look at valuation. Okay. Okay, so we actually want to compare the current valuation with the 5-year ratio. Okay, so 5 years is 18.63. Okay, so based on what was taught, okay, the fair value, the PE should be, okay, the PE should be 18.63 lah. All right. Okay, so currently the PE is 50.43. Can you tell me whether right now Disney is under or overvalued? Under or overvalued? Okay, overvalued. So currently it's 50.43. So very, very clearly, you know that right now is overvalued. Okay. Okay, so sorry, what was I doing? Okay. So currently it's actually overvalued, currently overvalued, which is actually 50.43. And this is the reason why, right? You can see that the current price right now is very overvalued. Okay, let's see. Am I seeing something wrongly? Current is 50.43, right? And Nita, how come you put current is 38.97? Am I seeing something wrongly? 38.97. Okay. Oh, that's what you got from Google Sheets, is it? Oh, that's what you got from Google Sheets. Okay. So maybe we can do a manual calculation. Okay, we can do a manual calculation. Okay, so how to get the current PE? Very simple. We take the current price of Disney. Okay, so Disney share price. Okay. Disney share price is 115.49. 115.49 we divide by the current EPS. Okay, 115.49 divided by 2.62. Okay, can you all tell me what's the value? 115.49 divided by 2.62. Okay, so this will be the most accurate one because you took the current share price divided by the EPS. Okay, so let's agree. Okay, 44.08 lah. Can we agree? Cannot. If okay, say yes. Okay, so currently we are 44.08. Okay, so let me just put it in. Okay, current PE 44.08. Okay, so currently we know that it is clearly overvalued. Okay, all right. So let's take a look at the rest of the PE ratios. Okay, so we took a look. Okay, so we have the 5-year PE, which is 18.63. This is the fair value. Okay, and then we take a look at the previous years, right? Okay. Okay, based on 2012 to 2013, 2014 and all that, right? Can you give me like a range of values where you would think that, okay, Disney is actually undervalued? So we know fair value is around now 18. So what will be the undervalue? What do you all think? Okay, Maureen says 13 to 16. Okay, some of you took the average around 15. Okay, some of you, okay, so it's actually between 13 to 16 lah. All right. Okay, so let's just put that in. Undervalue. Okay, the P is okay, 13 to 16. Okay. Okay, so right now let's take a look at when is it overvalued. Actually, overvalued is now lah. Okay, so right, let's take a look. As you can see, right, based on previous years, right, you see, Disney has never ever come above 20. Has never ever come above 22 leh. Yeah. Okay, EPS drop a lot. Yes, okay, so Ambrose is right. Okay, so the reason why the current valuation is a bit strange, right, is because of the EPS. Okay, so later on we will demonstrate this together. Okay, but right now, would you all agree with me that 22 is actually above 22 is overvalued? Would you all agree with me? If you all agree, can you say yes? Okay, okay, so over here, we put here, okay, PE, if it's above 22, we consider this overvalued lah. We consider this overvalued. Okay. Okay, so right, so Rebecca over here, right, has done her calculations, okay, based on the current EPS. So let's take a look at the current EPS of Disney. Okay, can you type in what's the current EPS of Disney? Okay, 2.62, right? Okay, so we actually so number one, we go and do a calculation. Okay, we do calculation based on 2.62. Okay, based on what Rebecca has done, she did a calculation based on 2.62. Okay, this was 60.26. Okay, then the fair value, I think, is 48.81. Okay, I just based on her Excel sheet here. Okay, which is actually all very, very undervalued as compared to the current price. Okay, so which makes it very, very difficult to enter. So right now we want to actually see whether this EPS of 2.62 is it a realistic EPS to use or not. Okay, so we take a look at the previous EPS. Okay, do you all realize that 2.62 is actually quite low as compared to previous years? Okay, so like what was mentioned. Okay, what do you think actually caused this very low EPS this quarter? What do you think? What do you think caused this very low EPS this quarter? Okay, because Disneyland had to be closed. Okay, yeah, therefore their earnings actually took a very, very big hit. Okay, so you have to bear in mind when you use a very low EPS, then the share price that's calculated is going to be very, very low. Okay, so right, can I ask you all, do you all think that this low EPS is going to be a one-off thing or forever is going to be like that? Okay, one-off or forever? One-off or forever? Okay, if it's going to be one-off, right? Okay, then actually we may not want to take this value lah. We may not take this value. Okay. Why? Yeah, it's recording. Why? Huh? Why? Oh, it's recording. It's recording. Okay. So right. Okay. So So then, can I ask you all what then should we take as the EPS? Because you see, the previous year 6.64 also looks a bit high. 8.36 also looks very, very high, right? Okay. So what do you all suggest? Okay, you want to take average? Okay, very good. Okay, so we are all thinking together. Okay, should we take the average of the 10 years or 5 years? What do you all think? We just think together as a community. What will make sense for you all? 5 years or 10 years? 5 years or 10 years? Okay, most people are saying 5 years. Okay, so why don't let's just do the calculations now. Okay, let's take the EPS 5 years. 4.9 plus 5.73 plus 5.69 plus 8.36 plus 6.64 divided by 5. Can you all tell me what's the value? Okay, what's the value? Okay, so we get around 6.26. 6.26. Okay, so we just do a very rough calculation. We get 6.26. Okay, so let's just do this. Okay, so right now, let's just use, 5-year EPS. Okay, 6.26. Okay, so, so we just do this and see whether it makes more sense. Okay, so 6.26, can you help me to calculate? 6.26 times 13, what do you all get? 6.26 times 13. 81.38. Okay, then after that, let's do 16 times 34 16 times 6.26. What did we get? 100.16. Okay, so can you all see that right now, if you use this one, okay, do you all think is actually reasonable? Do you all think is reasonable? Okay, so it's yes. Okay, so I want to answer Gordon's question. Okay, because right, the EPS, right, we are using a 5-year average. Okay, but then we are looking at a 10 years PE ratio. Okay, so he's asking whether this is accurate or not. Okay, so Gordon, my answer to you, right, is that okay, the EPS, right, for the company, right, actually changes from year to year depending on the performance of the company. Okay, so what is PE ratio, right? It is actually a reflection of its share price over its earnings per share. So actually it reflects the investors' confidence in this particular stock. So sorry? Market sentiment or the investor sentiment are people who actually want to buy Facebook. So okay, so for example, right, if I were to take a look at, for example, what happened, okay, so like for example, right now, right, currently 50.43, it shows that okay, currently the market, right, okay, is very very bullish on Disney. Okay, why? This is could be because of things like Disney Plus. Okay, because previously they launched Disney Plus, and that was new. Okay, and therefore people were actually very bullish, and also because of the very good performance for their Marvel movies lah. So this could be a reason why. Okay, and that, whereas for the last 10 years, right, it could be that okay, the market sentiment when it comes to Disney, the confidence is actually it stayed relatively the same. So that's why it was actually like this. Okay, so to me, right, it's actually okay to take the 10-year PE history because this tells me what is the market's confidence or sentiment on Disney. Okay, and to make it more accurate, I want to apply an EPS that will be more realistic for me to project moving forward. Okay, Yeah, so Gordon, if that makes sense to you, can you just respond? Okay, okay, so right. Okay, thank you, Gordon. Okay, so now let's take a look at the fair one. Okay, so fair PE ratio is 18.63, which is the current PE ratio. So currently, 115, 18.63. So let's do 18.63. Okay, thank you. 116.62. Okay, 116.62 would actually be a fair value to enter. Okay, what about 22 times 6.26? What do you get? Okay, 137.72. All right. Okay, so after this is what we mean by being nimble. Being nimble and as investors, okay, we don't just apply the rules like that. We also, okay, if let's say it is very out of the current price range, we also ask ourselves, why? Could it be that number one, my PE was selected not so correctly? Or it could be number two, okay, my EPS was not entered correctly. Okay, so if this if you understand what is going on here, can you please type nimble? Nimble. Okay, so the next one we want to look at was EA, because EA also looked a bit strange when people did the evaluation. Okay, so I'm just going to go to, okay, I think Joyce had a very nice PDF done. Okay, so let me just see whether I can find it. Okay. Yeah, do I have it? Joyce. Okay. Okay, maybe I look at sorry if I pronounce the name wrongly. Jun Yi's one. Okay. EA is massively undervalued based on Jun Yi. Okay. So okay, let's take a look at. Okay. So it was actually massively undervalued. Okay. So let's take a look at EA. Then you all tell me why was it that EA's pricing actually didn't really make sense also. Okay, so can you tell me, right? Okay, what is the current EPS of EA? If let's say you want to do your PE valuation calculations, right? Okay, what's the current EPS of EA? 10.53, 10.53. Okay, do you think it's actually, okay, based on the previous history of the EA, right? Okay, do you think it's realistic to use 10.30? Yes or no? Not realistic, right? Not realistic. Okay, so unless you're telling me, okay, unless you have gone through the entire fried snake and you are able to tell me that, okay, I think that EA is actually able to sustain this 10.30 EPS. Otherwise, right? Okay, okay, so Ryan, okay, so Ryan, you said that it has some adjustments in the tax. Okay, so a tax refund or something. So this may not be a realistic EPS going forward. All right. Okay, so what I would suggest, right, is that you would actually, maybe it may make better sense for you to take the 5-year PE ratio starting from here. Okay, and then you take the average of it. So for people who did EA, can you please type EA into the chat? If you did EA, can you please type EA? Okay, I think Joyce also did EA, right? Okay, so if you did EA, okay, bear in mind, okay, you will actually need to change your EPS when you do your PE valuations. Okay, so you cannot be using 10 point something for your EPS. You need to actually take the 5-year average. All right. Okay, so I hope that makes sense to all of you. Okay, then the other one which also had a very funny valuation, I think, was Intel. So let's take a look at Intel. Okay. Okay, can you all type in for me what is the current EPS of Intel? Current EPS of Intel. Okay, current EPS of 5.15, right? Okay, so okay, do you all think that this EPS is realistic or not realistic? Can you all tell me yes or no? Realistic or not realistic? Okay, so some say yes, some say no. Again, it goes back to your own understanding of the company. Okay, so you may say yes if you feel that, okay, you may say yes if you feel that, okay, you think that Intel can continue to sustain this 5.15 lah, okay? But like what some of you have pointed out, what do you realize about the number of shares? What do you all realize about the number of shares? It has been decreasing, right? It has been decreasing. So actually this 5.15 Okay, what do you think it is? Do you think it is true or is it cheater? Can you type true or cheater? Okay, it's cheater. It's cheat a bit. Yeah, it's cheat a bit. So actually, right, okay, so actually, right, yeah, so you are getting it. It's actually a cheater. So you may not want to use 5.15 when you do your valuation calculations. Okay, so again, I leave it up to you all to be nimble, because all of you, I trust that you all are independent investors. Okay, so you can either choose to take, you can choose to take like a 5-year average. You may want to see whether you want to include this current one. Okay, but if you feel that, okay, you're not very comfortable to include the current one, then you can take the next 5 years lah. Okay, so I just want you all okay, so what I want you all to take away from this entire feedback session, right, is that when you all come out with the valuation, okay, when you all come up with this valuation, okay, this valuation, okay, do a second step, okay, to see whether the EPS that you're using, okay, is it actually a realistic EPS? Okay, if it's not realistic to you as an investor, then you go and do your own adjustments. Okay, go and take the 5-year EPS, for example. Okay, second thing that you want to look at is, okay, these PE ratios that you are looking at, is it also realistic or not? Okay, if it's not realistic, if you see that there are certain outliers, then you may want to discount them and take the average. Okay, okay, if this is helpful to you, can you please type H? If it is helpful to you, can you please type H? Okay, thank you. Okay, so for the people who actually have done your homework, okay, so please take note to go and add in your portfolio allocation and your cash. Okay, go and take another look at your PE ratio valuation. Go and check the EPS and the PE ratios again. If you need to do certain adjustments, please go and do so. All right. Okay, the last thing that I wanted to share also is about, do take note of the currency that the financial statements is in. Okay, Justin, if book value and FCF is increasing, can I assume that share buyback is good, thus making EPS legit? Okay, so right now we actually, the exercise is to find out whether this EPS value, right, is it realistic for us to use this for our PE valuations? Okay, so again, it goes back to your own understanding.
Yes, answer is yes.
Okay, so Joe, you want to answer so that they can hear?
Okay, I would say a yes because
come over. Yeah.
I would say that it's a yes because they are in a very strong financial position.
Oh, I realized I didn't on video at all. Okay, sorry. Okay, yeah.
So I think definitely it's a yes for me.
Okay, so that means, Joe, you are saying that I can use this inflated EPS for the PE valuation as long as my book value and FCF is increasing.
Yeah.
Okay, so Pen. Okay. Revenue grew for INTC.
Yep. Exactly. Okay. So that means that their financial position is just getting stronger and stronger.
Okay, so again, it goes back to your own understanding of the company and and how conservative you are as an investor.
Yep.
Okay. All right. Okay. So next one, right? I want to talk about this conversion among currencies. Okay. So let's take a look at Adidas. Okay, so INTC, for those people who actually are very convicted about a company, I think you may end up using 5.15. If that is so, then congratulations, okay? You can already, I think you can already get a very good price for INTC. Okay, but for those of you who actually may not know INTC too well and you want to take the more conservative stance, you can actually go and take the 5-year average so that you can actually enter at an even better price, all right? Okay, okay, Gavin, okay, so you still think the 5-year average is better. Okay, that's great. Okay, so let's take a look at Adidas. Can you all tell me this $131.25, okay, this is in what currency? Can you all tell me? Adidas 131.25, what currency is this? Okay, so how do you know, right? How do you all know? Okay, so watch here. So this 131.25, can you all see that below here, what does it say? Can you all type in? What does it say? Okay, so the Adidas is actually the $131.25 is in USD. Yeah. Okay, but when you open up the financial statements, okay, what do you all see? Can you all type it in? The earnings per share is in what currency? Euro. Okay, very good. Okay, so when you all do your PE calculations, okay, let me see whether I actually have do I have Adidas? Okay, so for example, your PE calculations, okay, when you do this, right, you must make sure that you actually convert the currency, yeah, okay? So for example, how do you do this? Okay, so all you have to do is just put Euro to USD conversion. Okay, so when you do your calculations, make sure that you actually change the earnings per share to US dollars. So right now it's 3.49. Okay, so 3.49. Okay, so that means you should be doing your calculations based on 3.93. Okay, so back to okay, this student's homework. Okay, so for example, undervalued at 26, right? Okay, so undervalued price should be 26 times 3.93. Can you help to calculate that? 26 times 3.93. (26 times 3.9). Is it 3 point what? 26 times 3.93, correct? Okay. Okay, so 102.18. Okay, so I'm going to actually do some. Okay, so I know this is a bit small, but I'm just going to put one more text box here. Okay, so you all have calculated for me, 102.18. Okay, some of you are asking me to repeat. Okay, so I'm going to repeat. Okay, so when you do your PE ratio valuation calculation, you all take the PE ratio, okay, times the EPS, correct? Okay, so right now for ADDY, the undervalued PE is 26. Okay, okay, so when you times the EPS, you cannot multiply it based on another currency, because right now this is euro. Okay, so you need to change this euro to US dollars so that you can get you need to convert this one. Okay, so how to convert? I take 3.49. I use Google to convert. Okay, so 3.49 is actually equivalent to 3.93. Okay, so when I take 3.93 times the undervalued EPS, I get $102.18. Okay, so in this way, if this is being done consistently throughout, you should see a higher valuation, okay, for ADDY. All right, okay, so very good. Some of you have already mentioned, okay, like Baba is in CNY, so please do the conversion as well. If not, you're not going to get a meaningful valuation. Okay, and TSM as well. Thank you very much. Okay, so these are the three main feedback that I wanted to give, okay, for the homework. Okay, all right, so right now I'm going to actually give your homework for today. Okay, so today, let's take a look. Okay, so this is summary of day 1. Okay, so homework, let's take a look at homework. Okay, Joe, do you want to force them to do fried snake?
Yeah. Learn already how can do.
Okay, so right now homework for day 1. Okay, so we are going to level up already. No more level 1. No more level 1. No more. Okay, we are going to make sure you all do your fried snake analysis. Okay, fried snake analysis, do for 1 stock. Okay, for 1 stock. Okay, do fried snake analysis. Okay. Okay, so we want to see your portfolio allocation as well as your portfolio cash. Okay, please do so for 1 stock. Okay. Okay, Yaksan say we are fried. Yes, we'll be posting the video recording, okay? But this is a 2-hour video, so it will take some time for us to post it up. Okay, now valuation. Okay, same thing. Okay, we would like you to do your valuation based on PE valuation. Okay, optional, you can do basic PTA to substantiate it. Okay, but please, okay, please make sure that you are also nimble. So level 2, we want you to do nimble. PE valuation. Please go and take a look at the EPS history and the PE history to determine a more meaningful valuation. Okay, please also remember to go and do your currency conversion. Okay, remember to check currency. Okay, yeah, okay, so we will immediately after this, this entire recording will be encoded. Okay, then we will upload it as soon as possible. Okay, then for Christopher's question on book value, expected dividend, all that, we'll cover that tomorrow, because as what you all have mentioned, you all feel very fried already. Okay, so I think there's no point pumping more information to all of you. Okay. All right. Okay. So even though it's actually not even 4 o'clock, but it really felt like it has been a very long day already. Okay. So, so 2 basic homework. Okay. Valuation. Okay. Do all this. Okay. If you all understand the homework, can you all type understand? Okay, very good, very good. Okay, so right now we want you all to post this on the OMM Facebook group, please. Okay, so that we can actually give your feedback. And we would we would actually upload the video for today's recording onto Facebook group as well. Okay, and you all realize the more homework you all do, okay, the more you all learn, and actually the more homework you all do, the more valuable the feedback we can give to all of you as well. Okay, all right, so if you all learn a lot today, can you all type learn? If you all learn a lot today, can you all type learn? Okay, very good, very good, very good, very good. Learned. Okay, very good, very good. Okay, good. So the next thing you all must do is you all must practice, huh? You all must practice. Okay. Very good, very good. Okay, so now we are going to share with you what will happen tomorrow. So today, okay, after this, please go and have a good rest while waiting for the video to be uploaded. Then go and do your homework. Okay, tomorrow when we come back, all right? When we come back, we are actually going to, okay, so let's see, we're going to review your homework. Review homework. Okay, then Joe will actually go into the PEG, dividend, right? And asset. Book value valuation. Book value, okay, valuation method. Okay, then if you are still not fried, we can go to TA part 2. Okay, then after that,
Victor, no DCF. I think DCF were really.
I think really fried already. I think this is already enough. Enough already. Okay, so DCF maybe we'll cover it during the Facebook live sessions or something. Okay, then okay, application time, and then we want to talk about your portfolio as well. Portfolio is really, really important. Portfolio. Okay. Then after that, we will go for lunch tomorrow, and then we will actually go into the income generation system. Okay, your exponential growth system, and then trade journal, because many of you are asking whether is there a template for trade journal or anything like that. So we will talk about this. Okay.
Sorry, Ismail, what is the valuation method that Sean uses in his course?
Yeah, Ismail, maybe you want to share with us what kind of valuation, because based on what we have heard, Sean actually uses the PE valuation. I think is there any others? DCF he also uses as well, right? Yeah. Okay, so for a start, right, I think what you all learned today okay, so the PEG, PB will actually be covered tomorrow. Okay, tomorrow, if let's say you are still not fried, we can cover DCF lah. But must bear in mind that we actually do have quite a lot of content to cover. Okay, so we want to actually make sure that you all have actually leave this course with a solid foundation. Whatever extra stuff, right, we can always cover during Facebook Live. Okay. Okay, so option strategies yet to be covered tomorrow during the income generation exponential growth strategy. All right. Okay. Which course are you all with? Oh, this current course, this current 2 days masterclass. I'm referring to this current 2 days masterclass. All right. Okay. So remember, this 2 days masterclass is really to build up your foundation. Okay. So once you have your foundation built up, then later on when we actually share with you more advanced stuff, it will be easier for you to catch as well. Okay. Yeah.
Okay, Meng Chun, I'm not so worried about the currency crashing because we just wait and see. Okay, because right now we are more interested in evaluating good companies. All right.
Okay. Anything else to add, Joe? Okay. All right. Okay, Ismail, thank you. Okay, so we'll cover all these things tomorrow. Debt to equity is not a valuation method. Debt to equity is actually a part of the company analysis, which is part of FRIDE. Okay. All right. Okay. So, okay. Anything else to say to them?
No.
Okay.
No.
All right. Okay. So if you will do this homework, can you type I will? I will. Can you please type I will if you will do this homework? I will. Okay. So all these people who say I will, you better do. If not tomorrow, tomorrow. We will make sure we fry you up. Okay, very good. Okay, good. Okay, very good. Okay, so that's all that we have for you for today. Okay, so please rest well, and we will see you again tomorrow. At what time? Can you all type in what time do we see you tomorrow? What time do we see you tomorrow?
Yeah.
Yes, 9 a.m. Okay, so it will be the same link. Okay, so we will see you at 9 a.m. tomorrow. Please be on time. Okay, because today I think there were some people who stream in quite late. Okay, so you missed out certain things at the front. Okay, so tomorrow we'll see you at 9 a.m. Don't be late. All right. Okay, and we will see you. Bye-bye.
Bye-bye.
Bye.